On today's show, how comparing tax benefits between products is a major consumer feature. Part 5 of this week's series on tax investment strategies with nationally recognized columnist Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author and a background technician in InSmart. Let's get down to business.
Hey,
well,
Steve.
welcome to the show, day 5. Now, we're kind of going to do something. This is a little Kenism today, so I've got to go we have to kind of, go into the new way of thinking. Ken's got this kind of 3 stars or 3 bullet point. I don't know what you're doing. You're going to rank the power of our product line by this new ranking system. Maybe we'll start something here and we can copyright it and then get a show on it. We know, I always think, Ken, what 3 stars? I got tax deferral and I got tax free. Walk me through your mechanics of how you rank it as a CPA, the power and the value of what you're saying, and then give me your new ranking system. I kind of like that.
Well, I discovered when I was talking to my clients that when we start talking about, oh, look at all the cool tax benefits. I get tax deferral. I've got tax-free distributions, or I have tax-free death benefit. That's a life insurance policy. It has all 3 of those. And then I try to explain an annuity versus an annuity and a modified endowment contract. Well, using all those long words becomes cumbersome and difficult for people to follow. So what I did is when I'm comparing them, I say, okay, what does an annuity do for us? From a tax perspective, all it does is tax deferral. There's no deduction up front. There's no tax deduction on the end. And there's even a 10% penalty before 59.5 at the end. So it's a 1-dot product, okay? A 3-dot product is life insurance. I get tax deferral. I get tax-free distributions during life if I do it right. And I get tax-free death benefit. So that's a 3-dot product.
I kind of rather have these like 3 stars.
Oh, okay. Well, we'll do 3 stars for your show.
Because it sounds cooler.
Okay. So then there's the modified endowment contract, which when that first came out, everybody freaked and says, oh my gosh, don't do that. That's evil and terrible. Stay away from MECs. Well, the fact of the matter is they can be used appropriately. For instance, a single premium inside of an irrevocable life insurance trust for life insurance, you don't care whether you can take cash out or not, because you get tax-free death benefit and you get tax deferral. So it can be held in the trust without taxation, and at death it's tax-free. So we really don't care about distribution kind of things. Now with things like life insurance that are primarily long-term care benefit assets where the cash value doesn't change, it just stays constant. You don't care because if you put $100,000 in, take $100,000 out, is there any taxation? No. So you really don't care about tax basis and tax-free distributions. And that essentially is a MEC. It's a modified endowment contract because it's a single premium asset.
Now, if you saw a couple weeks back, we had attorney Ike Devji on, and he is an asset protection attorney, deals with high-end doctors and attorneys. I mean, really huge practice. And he's a national columnist. If you haven't seen his shows, go back out and check it out. It's really worth watching. Ike uses, and this is an attorney, uses MEC contracts for holding corporate monies to get them out from a strictly liability issue. He doesn't care if they really make money or not. He just wants to be even Steven on it. He just wants to get it out of the business as a standalone tactic to get the exposure, not only of liability in case he gets sued, but he wants to get it off the tax books as well. He wants to push it to his personal side of this issue and put the money over there. To me, when I started hearing attorneys talk this way, when I started seeing you start to talk this way, I'm thinking, wow, CPAs and attorneys are actually seeing and adopting the tax benefits that we're talking about. So let me review. 1 star is tax deferral. 2 star is kind of like a MEC because it's
a tax deferral and tax-free death benefit.
And you get a death benefit. 3 is a TAMRA compliant life insurance contract.
Right.
So those are your 1 star, 2 star, 3 star. I didn't mean to post stars on you, but I kind of like that.
That works.
Now, when I think about non-qualified annuities, Ken, why do we get this special treatment of basis when you start to annuitize, especially if you do a lifetime? It's why I can't believe the government is okay with this, because they changed the law somewhere around the FIFO-LIFO law. I think it was back in '84 or whatever it was. They changed it, but they left annuities alone.
Well, yeah, basically, we actually have 2 sets of tax laws as it relates to annuities. There's the law as it's applied on an annuitized contract, and then there's non-annuitization partial withdrawals. If you do partial withdrawals, they do a last in, first out basis. They look at the last in, obviously, is your income that comes out and is fully taxable. So if I've got $100,000 annuity with $25,000 in gain deferred, I take $5,000 out. I haven't fully utilized that $25,000, so all $5,000 is deductible. When I take an annuitization, they say, okay, well, we're going to allow them to amortize basis. Now, I can understand the amortization of basis because now this is kind of a stream of income. It's going to be used probably for retirement, and the government wants to kind of promote us being responsible for ourselves. Where there's actually a tax loophole is that it is a straight line amortization. And if we did a regular accrual accounting, you'd actually have less basis used in the earlier years and more taxable income. But we do get to, if a guy's going to live 20 years, he's put in $100,000, we divide 20 into $100,000 and get to take $5,000 a year as return of tax basis, and it's only the excess over that that's taxable. I like the sliced cake analogy, okay? If I take a cake and I'm doing a partial withdrawal, the upper layers are your gain, so they come off fully taxable. If I do annuitization, I do a vertical slice, and I go through all layers of the cake, the original tax basis plus the earnings. So I get a little bit of both.
Yeah, in fact, actually, I think Curtis Cloak calls it first in, blend out. We'll be right back right after this break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Okay, now we're going to sound a little bit heretical here, right? Because everybody's so death on modified endowment contracts. Actually, though, I'm letting my tax bracket dictate if I'm going to leave my TAMRA compliant non-MEC contract, right? If I knew I was going to amortize that, I'd even lower the death benefit below the TAMRA guidelines, knowing full well that I'm losing my tax-free status of withdrawals to basis, policy loans to gain, because I might want to take that number and see what the actual lifetime annuitization is off that. Now, the only reason people say, Steve, why do you look at that? Once I see the tax bracket is going to be lower because we're doing all these tax things to really bring it down, I'm going to have to look at that just before distribution. I'm happy to look at arbitrage loans on an index contract. I love that. I'm happy to look at other chassis that don't use arbitrage, but we get withdrawals to basis like we were talking about in the first, free. But I want to look at this issue of a modified endowment contract because many of our carriers don't treat the same schedule for mortality credits on their life as they do on their annuities, which is shocking to me. And there might be a play here. And you and I have seen taking a regular life contract and annuitizing it, and the difference between that lifetime income and the withdrawals to basis and policy loans to gain, which has to come out perfectly in performance of the contract, right? We've seen this. We look at it, maybe we should do the MEC contract here.
Well, actually, I think there's two really important issues. One is the tax impact. How much income do I get to spend on the distribution? And of course, if we do it right with a regular non-qualified plan, we can take it out tax-free, either as withdrawals or as loans. However, if instead we annuitize the contract, and a lot of people don't know you can, built into every single life insurance chassis is the ability to annuitize the cash value based on a predetermined formula. And of course, you can do a 1035 exchange into an immediate annuity, tax-free. Okay, so you can take the better of the two. And the point is that your MECs can be used appropriately, and as opposed to doing a regular life. We looked at this years ago. It was a bank-owned life insurance policy, and it was, are we better off doing it as a regular life policy
with withdrawal to basis, policy loans to gain,
and or a MEC? And the MEC advantage is that you can stuff more cash in there and have less amount at risk and pay cost of insurance. So you're reducing your cost of insurance while increasing potentially your taxes to a certain degree. But when you do the comparison of a regular distribution like we like to do, a TAMRA compliant type policy, as you put it, or an annuitized life policy or MEC, the MECs have the advantage of those lower costs, and we can start accumulating much more quickly.
And we're not a proponent of this. We're just saying you got to look at both of it now when we go to distributions. And think about this. Ken, you brought up a great point. 1035ing, I might be wanting to look at what are the SPIA rates and mortality credits at the time of distribution. I'm going to be looking at deferred income annuities. That could be a major play. So I want to look at this. And remember, some of these chassis, remarkably, are old thinking technology. I think they're giving way more mortality credits on their life insurance annuitization than they are on their annuity product.
Well, let's look at the age of our client. You know, if I've got a 40-something person that can make contributions over 5, 10, 20 years and just do a regular tax-free buildup or tax-deferred buildup and tax-free distributions, that may work really well for them. But what if I have a 60-year-old? Mm-hmm. By doing a MEC, just throwing it all in one time and having lower insurance costs from the start for an older person with higher cost structures, that could become very significant. And of course, your older retirees are risk averse. And taking annuitization is, they know exactly what they're going to get. Every single month for the rest of their life, they know as long as Susie and Johnny are both alive, they're going to get that money. So there's that practical application as well. And then, of course, what is the tax effect? Well, some of my clients are conservative enough. They said, you know, I could save a little bit more in taxes, but I'm just really a whole lot more comfortable with this guaranteed income.
Let me say one thing before we leave for the show, and this week has been a great week of learning all these taxation issues. We have carriers now, and one in particular that is actually letting you take your death benefit and letting you amortize it over 10 years. You have to wait till you're 85 to do it. But that means that the first 2 or 3 years is going to be basis. That all comes out free. And after that, you'd have taxation. But remember, this could really be a great end game because maybe you burn through your qualified plans. Maybe you're all done with all your other money. This becomes a new backstop for the people who are really going to be in their geriatric years, 85, octogenarians. Wow. I mean, you know, so I could amortize a full death benefit. This isn't like selling it in the settlement market where you're going to get maybe 30% max or something like that. We're getting the full value. It's just amortized over a 10 pay. You get all the death benefit, And I think this is a new way life insurance is going to become a living benefit. I just want to give you a heads up and you say, Steve, who's doing this? I'll send you the information because it's hot and we're going to do a whole series on this because that's where we see the market going for living benefits with life insurance. Well, that's our show for today. Remember, before moving forward with any of the ideas, always consult your tax advisor, legal counsel, or your broker-dealer compliance department. And don't forget, you can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. We'll see you next week.